If you own silver, you probably need a neck brace today. 72 hours ago, you felt sick to your stomach. You watched the price crash through support levels like they weren't even there. The mainstream media was writing obituaries for precious metals. You thought about selling just to stop the pain. Then, 24 hours later, you felt like a genius. The price ripped back upward in a violent short squeeze, erasing almost all the losses in a single trading session. Welcome to the silver market in 2026. This is not price discovery. This is not supply and demand. This is financial bipolar disorder. And it begs the single most important question you need to ask yourself right now. Is a system that behaves like this, crashing 8% on Tuesday and rallying 7% on Wednesday, a safe and resilient marketplace? Or is it a totally detached, highly levered, algorithmic casino that is rigged to shake you out of your position before the real move happens? Today, on the Prosper Path, we are not talking about technical analysis. We are talking about market pathology. I'm going to show you why this insane volatility is not a bug. It has a feature. It is a weapon designed to break your psychology. If you survived the last 48 hours without selling, congratulations. You passed the test. But the final exam is still coming. Let's get real for a second. Did the fundamentals of silver change between Tuesday morning and Wednesday afternoon? Did a massive new mine suddenly open up in Mexico, flooding the world with millions of ounces, causing the crash? No. Did that mine suddenly collapse the next day, causing the shortage that spiked the price back up? No. The physical reality of silver, the metal in your hand, remained exactly the same. The mining supply is still shrinking. The solar demand is still exploding. The deficits are still record-breaking. So what caused this insane volatility? It was a CTA liquidation event. CTAs, commodity trading advisors, are essentially trend-following robots. They control hundreds of billions of dollars. They don't care about supply and demand. They don't care about the economy. They only care about moving averages. Here is exactly what happened. On Tuesday, the price of silver dipped slightly below the 50-day moving average. The moment it crossed that line, the CTA algorithms triggered a massive sell signal. They didn't sell because they hate silver. They sold because a line of code told them to de-risk. This created a cascade of selling that pushed the price down 8% in minutes. It was a flash crash. But then the banks stepped in. The bullion banks, JP Morgan, Citi, HSBC, saw this artificial selling. They knew it wasn't real, so they bought the dip. They scooped up thousands of contracts at a discount from the panic-selling robots. And once they had filled their bags, they simply pushed the price back up above the moving average. The robots saw the price rising, got confused, and triggered a buy signal to cover their shorts. This is the V-shaped recovery you saw. It wasn't a market. It was a video game. The price crashed because of a computer glitch, and it bounced because the banks exploited that glitch to steal money from weak hands. If you sold during the crash, you were the victim of an algorithm. If you bought during the crash, you acted like a bank. This volatility proves one thing. The paper price is broken. It has zero connection to the physical world. It is a derivative of a derivative, spun by a machine. So, is the system safe? Let me answer that with a history lesson. When a currency is about to die, it doesn't just quietly fade away. It thrashes. It screams. It has massive heart attacks. In Weimar Germany, before the hyperinflation truly took off, the price of gold didn't just go up every day. There were days where gold crashed 20% against the mark. People panicked. They sold their gold back for paper marks, thinking the crisis was over. 2 weeks later, those marks were worthless, and gold was up 1,000%. What we are seeing in silver right now, this insane volatility, is the exact same symptom. It is the sign of a dying currency trying to fight for its life against real assets. The dollar is losing control, the bond market is losing liquidity, and when the central planners lose control, volatility explodes. But here's the trap. This volatility is designed to kill leverage. If you're trading silver on margin, if you are trying to use 10x or 50x leverage to get rich quick, this market will murder you. When the price crashes 8%, you get a margin call. You're forced to sell at the bottom to cover your debt. Then, when the price rallies 7% the next day, you're left with nothing but an empty account and regret. The banks know this. They engineer these swings specifically to hunt stop losses and wipe out leveraged traders. They are harvesting the liquidity of the gamblers. This is why I scream at you to hold physical. If you have a 100 O's bar of silver in your safe, did you get a margin call on Tuesday? No. Did your silver bar shrink in size? No. Did you lose any sleep? No. The price on the screen is for the gamblers. The metal in your hand is for the historians. The system is absolutely rigged against the trader. It is designed to churn you and burn you. But the system is powerless against the holder. They cannot force you to sell what you physically possess. They cannot margin call a safe deposit box. You're watching the death throes of the paper derivative market. It is becoming unglued. Expect more of this. Expect 10% swings. Expect the impossible. But do not, under any circumstances, let them scare you out of the only asset that has survived every currency collapse in human history. So, here's the verdict. We have exposed the V-shaped lie. We have proven that the CTA algorithms are driving the price, not supply and demand. We have seen the currency heart attack playing out in real time. The system is rigged. But it is only rigged if you play their game. If you are sitting in front of a screen trying to outtrade a billion-dollar supercomputer with 50x leverage, you are the prey. You are the liquidity they are harvesting. But if you are sitting on physical metal, you are the predator. You are the one draining the vault while they play video games with paper contracts. This volatility is not going away. In fact, it is going to get worse. As we get closer to the end of the fiat currency system, we will see moves that defy logic. We will see $5 drops and $5 rallies in the same week. They want to give you motion sickness. They want to make you doubt your conviction. They want you to say, I can't handle this, just give me my dollars back. Do not give them that satisfaction. Here is your battle plan for the next volatility storm. 1. Zero leverage. Do not borrow money to buy silver. Do not trade futures contracts unless you are a professional. Leverage is the tool they use to kill you. Cash and metal is king. 2. Buy the fear. When the price crashes 8% in a day and the news says silver is dead, that is your buy signal. That is when the premiums drop. That is when the weak hands fold. Be the buyer of last resort. 3. Turn off the screen. Once you have bought your position, walk away. Do not check the price every hour. The price is a psychological weapon. Disarm it by ignoring it. We are entering the most dangerous phase of the bull market, the phase where they try to shake off the passengers before the rocket takes off. The volatility is the turbulence. It means we are breaking through the atmosphere. If you sell now, you crash. If you hold, you reach escape velocity. I want to know who has the stomach for this. Drop a comment below with, I hold the line. If you are ignoring the crash and stacking the real thing, let the gamblers get wrecked. The wolves are waiting. Stay liquid. Stay dangerous. And when the paper market burns, make sure you are holding the fire insurance.